Welcome to the special live stream session. And I am super fired up to talk about the Federal Reserve's decision today on interest rates. And if you've been following the stock markets recently, you know this one's a big deal. In less than 30 minutes, about 27 minutes from now, the Federal Reserve is about to announce its latest decision on interest rates, and it's expected to shake things up for everyone, from your mortgage rates to your retirement funds. And if you look at the mortgage rates today, it is at a 2-year low, down to 6.3%. So that is good news. Let me grab my stool over here because I'm a little old. Kind of, not really, but better for my knees. But anyway, now before we jump into the details, I just want to say I am streaming this both publicly and in our private community. And if you want to join the group of investors who actually enjoy digging through this stuff, check out firesession.com/community. Okay. Now we have TSP investor group, we have 401k investor group, and we have like the Roth IRA investor group too. So I do post updates in there periodically, almost daily, except for Saturdays and Sundays. But anyway, check it out when you get a chance. We got real conversations in there. I don't do any scary headlines, as you know. I don't do clickbait titles and stuff like that, like other YouTubers do. Just serious talk about how to protect and grow your money so that you can achieve financial independence and potentially retire early. And we just recently celebrated someone achieving a 7-figure milestone in investments. Not a net worth millionaire. They already achieved that, but an investment millionaire. It means that they have over 7 figures or $1 million combined, all 401k, Roth IRA, taxable brokerage accounts. So that's a huge milestone that we got to celebrate that. But anyway, all right. So let's set the stage. The Fed's decision is dropping at 11 a.m. Pacific Standard Time or 2 p.m. Eastern Standard Time, and followed by Jerome Powell's press conference at 11:30 a.m. Pacific Standard Time. And that's also 2:30 p.m. Eastern Standard Time if you're watching this from the East Coast. And that's where the real story usually unfolds. And you can take a look at the stock market chart, how it just goes up and down based on what Jerome Powell says during the press conference. And what the Fed says in their statement is one thing, but what Jerome Powell means in the Q&A is another. So he's going to make a statement, right? And then he's going to go through all the Q&As after his statement with all the reporters. So that's going to be pretty exciting to see. Let me show you in some of the screens, and I forgot to share my screen here. Okay. All right. Any chance you think they cut 2 points? No, I don't think so. I think they're going to cut by 25 basis points. I don't think they're going to cut 200 basis points. Unless you meant like 50 basis points, Chip. I don't think it's going to be 2 points. But anyway, so the truth about today is that the Fed is making this decision flying mostly blind on the labor market, right? And I can't say it any plainer than that. And as you all know, the government has been shut down, and that initially put a complete stop to the Bureau of Labor Statistics. But there was a last-minute push to get the inflation numbers out. And the good news is we did finally get this September CPI report, and the one that drives your COLA adjustments. And however, the Fed is still in a blackout on the single most important piece of data for their mandate, which is the September jobs report. And we're probably going to miss the October one now. And that means we're missing the most critical report they need to make a decision on, and the one that will tell us if the unemployment rate has crossed the Fed's own projected pain threshold. And they are acting on a guess about the labor markets today, right? And Jerome Powell is trying to land an airplane on a foggy runway with no lights and a broken altimeter. And the last official solid hard data he has on unemployment is from August. And everything that happened in the 6 weeks since the data came out is a complete guess. And he seems to be confident, but he has no idea what's actually happening on the ground. And this is why the language in the statement at 11 a.m. is going to be more important than the rate cut itself. And they have to acknowledge this unprecedented lack of data without spooking the entire world or the financial world, right? And I'll tell you what, if the government were to resume operations tomorrow, which is highly unlikely, we will have a flood of data. And that's probably not going to happen until the following week, because everybody will have to come back to work and start doing all the stuff unless they have been collecting data in the background. Who knows? We will get the September jobs report. probably on November 7th, if the government resumes operations, and the September PCE inflation report on October 31st. And they are literally making a decision hours before a new set of data is scheduled to drop. And that's how close we are to a complete policy U-turn. And this is monetary policy by the seat of your pants, and it's going to make for great TV, right? Now let's talk about CPI inflation real quick. For and CPI stands for Consumer Price Index. And because the data we have all been waiting for finally dropped, and that government shutdown delayed the September CPI report, but it was released on Friday. And this is the exact number the government needed to calculate the 2026 cost of living adjustment for your Social Security checks, your VA disability compensation, and your military pensions. So what's the number? The report showed headline inflation for September rose to 3%, which was up from 2.9% in August. Core inflation, the number the Fed really watches, did cool down slightly, but that 3% headline number is what matters here. And remember that old, projection of 2.7% we were talking about? You can pretty much toss that in the trash with this final piece of the puzzle. The official COLA, which is based on the third quarter average, is going to be 2.8%. So your Social Security pension is going up by 2.8%. Your VA disability compensation is going up by 2.8%, and your military pension is going up by 2.8%. And I'm also, I did 20 years in the Air Force. I'm also a disabled veteran, so it does matter to me about what these COLAs say. And I'm going to break it down in a second. But if you're a federal employee, you get the diet COLA, which I'm going to make a separate video about that in the future. But anyway, I'm going to let's break down the official numbers on that COLA. Okay. That government shutdown delayed the big announcement originally, but on Friday, October 24th, the Social Security Administration also dropped the official number, and I'm going to make a separate video about that in the future, as I said. So be sure to subscribe if you haven't done that already, okay? But the cost of living adjustment for 2026, again, is 2.8%. And this is the number that matters for all of you, and not the COLA that came out for 3%. And that was the biggest misunderstanding in my private community. And they said, well, the COLA just came out as 3%. Isn't it supposed to be 3% for all Social Security net in the following year, as well as the VA disability and the military pension? No, it's 2.8%. So by law, all these benefits are tied to the same inflation calculation. So everyone gets the same 2.8% boost, except for federal employees. I'll explain that. And this is a slight tick up from 2.5% increase in 2025. So for the average Social Security retiree, this is going to translate to an extra, $56 per month. And for a disabled veteran with a 10% rating, your check is going to go up by almost $5. And for a veteran at 100%, it's about a $107 increase before you add in any dependents. Okay. And they all came from the September CPIW report, which was the final piece of the puzzle. And the bean counters take the average of the CPIW from July, August, and September. And then they compare it, and I forgot to change the screen here. They compare it to the same 3 months last year, which was July, August, and September from 2024. And that's how they got the final number at 2.8%. So again, the headline for 3% is it throws people off because they think that, oh, we're going to get that 3% raise in 2026. No, you got to look at the 3-month average between July, August, and September this year, and you look at the July, August, September of last year. Okay. Now, for my federal employees, under the first pension, not CSRS, or for federal retirees, federal civilian employees, you have a different set of rules, right? And if you didn't know that, this is something that you're going to learn. Your COLA is not 2.8%, unfortunately. So the first formula, I know it sounds like first, but it's first, FERS formula. So this is it's a pretty bad deal, in my opinion. The federal law states that if the COLA is between 2% and 3%, first retirees only get a 2% increase. So they call that a diet COLA. Get the reference, right? So since the official COLA came in at 2.8%, which is right in that 2 to 3% window, your first annuity adjustment for 2026 will be capped at 2%. So everyone gets 2.8%, right? Everyone else gets 2.8%. but first retirees get 2%. And it's a point of contention every single year. And quite honestly, it's a tough pill to swallow, and especially when you see health insurance premiums in the federal plans are set to jump over 12% next year. And I have a separate video coming out for that as well. As far as the SEP, since the Fed does not have any new fresh data, what are they relying on, right? Well, they are leaning entirely on their own playbook from last month. And we're going to pull up the summary. This is the summary of economic projections, or the SEP. And they released this on September 17th. And the next one that's going to come out is in December, in the December meeting. And this is literally their crystal ball, what they told us they think will happen. So let's just dissect this real quick, okay? Because this tells you what's motivating their decision today. So first, let's look at the change in real GDP. But before that, the federal funds rate right there. They are looking to cut rates 3 times based on this projection. I mean, it could change. This is just an assumption. So this isn't something that everyone follows and say, this is going to happen, right? So this is kind of the projection. But based on what we're seeing right now, they are looking to cut 25 basis points at each meeting starting in September. So last month, they already cut by 25 basis points. And then we're projecting that they're going to cut another 25 basis points today, and then another 25 basis points in December, okay? So first, let's look at the real GDP. So 1.6% growth for 2025. And that's not blistering growth, but it's not a recession either, right? They think the economy is okay. And right now, the GDP growth is showing 3.8% for the second quarter. We're not going to get that Q3 until tomorrow. So no, the day after. I'll double check on that. But anyway, but then look at the forecast for the unemployment right there at 4.5%. Now, remember, the last official number that we have is August, and it was already at 4.3%. And the Fed is actively predicting that unemployment is going to get worse by the end of the year. And this is a huge omission. If you listen to the last Federal Reserve conference call, not conference call, but the press conference, and they're baking job losses into their plan, and they call that a soft landing. And I call it, I hope I don't hit too many people, right? And finally, we got the PCE inflation, and this is something that they preferred, and that's their preferred inflation gauge. And they're forecasting 3% for 2025 and 2.6% for 2026, but their target is 2%. The fact that we just got the September CPI report showing that headline inflation, or the CPIU, is also at 3% tells me that the Fed's prediction on inflation is going to be sticky and settle at a higher level than they want. And keep in mind, CPI and PCE inflation, they're not the same thing. And I talked about that in a separate video. And they're literally telling us that we're cutting rates, but we also think inflation is going to be sticky and it's going to stay higher than our target. And we don't think we'll hit 2% until 2027. And the contradiction is that they're giving up on the inflation fight, or at least they're signaling a white flag, so to speak, in favor of saving the job market, right? Now, take a look at their roadmap for interest rates. So this is also called the FOMC dot plot. And every member of the committee, so keep in mind, Jerome Powell is not the only one who votes and says, we're going to raise interest rates or drop interest rates. He's not the only one making that decision, right? So there are committee members voting on this. So every member of the committee puts a little dot on this chart and where they think the Fed funds rate should be at the end of the year. And if you look at the 2025 column, there's only that one person, just that one person right here, at between 2.75 and 3% by the end of 2025. Now, I'll give you one guess on who that is, right? And the line that cuts through the middle of all those dots right there is 3.6% right here, okay? And since the Fed funds rate was at 4 to 4.25% going into today, and they already cut 25 basis points in September, that 3.6% median was a clear signal. And that 3.6% number was telling the market that they plan on 2 more 25 basis point cuts by year end, except for that one member. And one more cut at the December 10th meeting. All right. So let's look at the CME group as what the investors are thinking here. All right. So let's forget about the Fed's projection just for a second. And the CME group's Fed Watch tool tracks the futures market, which is where traders put their money where their mouth is, right? So for today's meeting, right here, let me see if I can. Yep, it's just 3.75 to 4%. The market is already pricing in at a 97.8% probability of a 25 basis point cut. And I mean, when you have a 97% chance of something happening, it's not a prediction. It's almost a done deal, right? And if they don't cut, the stock market is probably going to sell off later on today because the market has already factored this in. And in my opinion, they're going to cut by 25 basis points today. However, if they cut by 50 basis points, and somebody pointed this out in the chat from Eric, what if they cut by 50 basis points? I think the market is going to be very confused on why the Federal Reserve cut interest rates by 50 basis points. Usually, if an unexpected happens, there could be a surge of buy into the market, right? And then people are like, "Whoa, they're cutting more rates. Let's go buy." And then they realize, they're like, "Wait a minute, is there something that the Federal Reserve knows that we don't?" And they just start selling off, right? That's what people do. Well, that's what the traders do. And then when they sell off, and then they could buy again during the press conference, whatever Jerome Powell says, and justifies 50 basis points. I don't think that's going to happen. I think they're just going to continue to do that 25 basis points, like it says in the summary of economic projections, right? And if you go into, and you can always zoom out here and then go into December here, and it tells you the probability if you go into the CME Watch group. The market is fully expecting on December 10th to cut another 25 basis points, and which would put the rate right in line with the Fed's dot plot projection of 3.5 and 3.75% for year end. And we're also going to get the new SCP at this meeting that will give us a better clue on their 2026 projections. Now, if you go into the January 2026 or January 28th, 2026 meeting, they're looking at a 41.6% chance that they're going to cut rates again down to 3.25 to 3.5%. So we have to go back to the Fed's dot plot when it gets released on December 10th, 2025 to see how many rate cuts they're potentially looking to do for the remainder of 2026. And sometimes it's too soon to tell, right? We're going to get that in December. We're going to get another SAP in March. And we're going to get another SAP in June, September, and then December. Another thing to keep in mind is that Jerome Powell is going to get swapped out by summer of 2026. So whoever the new guy is going to be, that he's going to be pushing hard to cut interest rates throughout 2026 because he's going to be a very close ally to Trump. And Trump learned that lesson, from 2017, 2018, when he nominated Jerome Powell. He wanted him to be his ally, and now he's realizing that he's not much of his ally. So he's probably going to nominate someone who is very close to his agendas, right? Okay. Now, in this decision today, all hinges on the labor market, and the Fed has been saying for years that it needs pain to get inflation down. Well, they're finally seeing the labor market start to bend. Now, let me talk about the thing I get asked every single day. And the one thing that will not change today is the mortgage rates. Okay. Now, everybody's kind of stressing about this mortgage rates because it's not going down as fast as what people liked, right? And it's frustrating some people because they want to refinance and they bought their homes at 7%, 7.25% interest. But the good news is we are seeing a mortgage rate drop to the lowest level in over a year and a half and pushing refinancing 111% higher annually. So they have more applications coming in because the 30-year fixed mortgage rate is down to 6.3%. And this is interesting because the 10-year treasury yield right now is still looking at about 3.995% last I checked, right? So why are we seeing quotes like 6.3% or 6.23% today? It just makes no sense to the average guy trying to buy a house or refinance, right? And this is the most critical disconnect in the entire financial system right now. And you need to understand it. The Fed controls the federal funds rates, which is the overnight rate banks charge each other. And it's a leaky faucet of cheap money. But mortgage rates, they're pegged to the 10-year treasury yield. And this is the big, giant global fire hose. And the Fed does not control that fire hose. And the reason that the 10-year treasury yield is so stubborn right now and is still high is the federal debt and deficit spending. And our government is spending money at a breakneck speed. And to pay for it, the treasury has to issue a massive historic supply of new bonds. And when you flood the market with supply, the price of those bonds falls, right? And when a bond's price falls, its yield, which is the interest rate, goes up. So you have a massive tug of war going on. Some people are pulling on each end, and the Fed is pulling on this tiny rope trying to lower the short-term rate. Meanwhile, the Treasury Department and Congress are attached to a freight train of new debt, pulling the long-term rates, your mortgage rates, in the opposite direction. And a 25 basis point cut today is a drop in the ocean compared to the billions of dollars in new debt or trillions of dollars in new debt hitting the market every single month, right? And until, well, I shouldn't say trillions of dollars every single month, but I would say billions, right? And we're at $37 trillion in debt right now. And until the Fed decides to start buying up all the long-term debt, which is a whole other mess, your mortgage rates are going to stay elevated. And this is a structural problem that a rate cut just cannot fix, okay? I hope that makes sense. So between now and the October, so today and the December 10th, 2025 FOMC meeting, there's a packed lineup of critical economic data that will guide the Fed's next moves. Okay, hopefully, if the government starts operating again, the calendar includes the Q3 GDP report on October 30th. Okay, so which is tomorrow. I was right. And then another one on November 26th. And the PC inflation data comes out on October 31st and November 26th. And these are key indicators of whether growth is holding steady and inflation is cooling fast enough, right? Which I doubt it's going to cool down. Then as we move into November and December, attention shifts to the JOLTS, job openings reports, which comes out on November 4th and December 2nd, and the CPI, which is inflation, on November 13th and December 10th, which is the same day for the next Federal Reserve meeting, and PPI and retail sales both released on November 14th. And as for the crucial missing unemployment report, these are coming out supposedly on November 7th and December 5th. But if the government shutdown continues throughout November, we might get two pieces of data all at once on December 5th. That's if the government reopens, and we'll see. So all of these will hopefully reveal how strong the labor market is or how weak it is and consumer demands, right? And the series of updates capped by the next federal interest rate decision on December 11th. December 10th. I don't know why I put December 11th. Will shape the tone of monetary policy for the rest of the year and signal potentially going into 2026. And today's rate cut cycle continues, or are they going to potentially pause later on? Okay, hopefully the government does reopen soon, because this is kind of getting annoying with the government shutdown. And in about 3 minutes, we're going to get the reports presented to us. Let me find out if I can pull up Bloomberg here.
Kind of getting ahead of its cost and pricing in too many cuts seems like it's a bit much. And then you add in easy financial conditions, you're left with an environment where maybe the Fed has some sort of leeway in trying to not ease as much in this environment.
So, Roger, I'm going to pick up on Bob Michael's insight there about what I call log convexity. Are you seeing?
As we're counting down, I know somebody in the private group had a question. Yes, it is 2.8% for the COLA increase for your Social Security, 2.8% for military pension, and 2.8% for VA disability as well. Okay.
What's concerning is the fact that there's absolutely no volatility in the market. Look at, bond volatility. You look at implied volatility in the bond market or in the equity market. there's absolutely no concern. So to me, the lack of volatility in this environment is also troubling, because you tend to see a lot of investors kind of getting lulled into a sense of security and continuing to sell vol anytime you have a pop and vol. And that's an environment that is concerning, given the fact that we do have a decent amount of risk. We're going through a shutdown right now. There's potential for meaningful deterioration in a lot of these fundamentals that we're looking at. We have no clarity on the data. So I think a little bit of caution is required from that perspective.
Subhadra, somewhere in this country, there are some college kids, maybe the Finance Society at the University of Alabama, taking bets on just how soon this news conference will end as soon as it starts. Are you betting on a short one today? What can he possibly say about what they don't see at the moment?
He's going to get his slew of questions from everyone, including Mike McKee. So the press conference will probably at least run 30 minutes or longer. He might get into the details on QT if they do announce QT. So I'd be curious.
Yeah, sorry. The TSP or the 401k contribution limits have not come out yet, but I'm expecting it to be released by Friday. That's what I'm guessing from the IRS. So just keep an eye on that. But I'll make a video about this soon too. So
seeing and hearing from their constituents, and that should shed some light on what they're thinking on policy. We'll also be curious to hear what he says on what he's going to be doing at the December meeting. Although they don't have a whole lot of information, the market's already fully priced in a cut. We'll have to see how he kind of discusses that.
Subhadra, thank you. It's good to see you. Subhadra Japa of SocGen. Those college kids will bet on anything, TK. You notice that these days? Absolutely anything.
Yeah, I've been in front of some of them recently, and they're eager to learn, and their heads are spinning like ours are spinning over this
there's a
moment we're living
global
in. I'm still saying
Microsoft
it's coming out of
services
COVID,
outage going
or
on,
maybe-
and a lot of apps are not functioning right now. I don't know if you guys are tracking that, but this is going to hurt the Microsoft earnings, which is supposed to come out at 1 p.m. today. So we'll see how that goes. This is going to be very interesting.
Have the most recent data, the only data we have is inflation, and headline and core around 3%, and the Federal Reserve set to cut interest rates at 25 basis points. I understand why, because they're worried about the labour market, but it's a kind of awkward situation not to have that official labour market data and still to be looking to cut interest rates with inflation around 3%.
And again, the dovish, hawkish tilt of a traditional Fed meeting.
Okay.
Maybe it's
Yep, they cut the rates by 25 basis points.
Decision,
I beat
just around
Bloomberg
the
again,
corner.
and
Let's check out the market. Start with equities. Equities this afternoon positive for a fifth consecutive session on the S&P 500 up by 0.2. In the bond market on 2s, 10s, and 30s, a snapshot of fixed income yields higher at the front end of the curve by 2 basis points. Likewise on 10s. With that Fed decision, here's Mike McKee.
A divided Fed cuts their benchmark lending rate by 1/4 percentage point and says they are going to end QT December 1st. There are two dissents as policymakers reset the target range to 3 3/4 and 4%. No surprise, Stephen Byron dissents in favor of a 50 basis point cut as President Trump wants. And Kansas City Fed President Jeffrey Schmidt dissents on the other side in favor of no move. The Fed's administered rates for interest on reserves and the primary credit rate mechanically decreased by 1/4 percentage point along with the Fed funds target. As for the balance sheet, the Fed will stop redeeming maturing Treasury securities at the end of November. Principal payments will be rolled over going forward. The mortgage cap of $35 billion a month remains in place, but as of December 1st, all principal payments on maturing agencies will be reinvested in Treasury bills. Fed officials gave a nod to the government shutdown in their economic assessment, noting that, quote, available indicators suggest that economic activity has been expanding at a moderate pace. Job gains have slowed this year, the statement says, and the unemployment rate has edged up but remained low through August. More recent indicators are consistent with these developments. They changed the tense on the balance of risks, noting downside risks to employment rose in recent months instead of have risen. And uncertainty about the economic outlook remains elevated, they say. There is no change to their forward guidance. The statement still says in considering additional adjustments to the target rate, they will consider many factors. Guys?
Mike McKee, stay there. What a decision by the Federal Reserve. So you cut interest rates 25 basis points, widely expected. They MQT.
Yeah, that is huge. So the Fed just said that they're going to start buying. They're going to roll over MBS payments into buying Treasury bonds. So that's they're ending QT, quantitative tightening, but they're going to buy bonds so they're yeah, this is going to be the stock market's going to be pretty happy going forward for the rest of the day today. All right, I'm going to go over the statement here.
4.01%. TK, these aren't major moves in financial markets, but there is a subtle shift in this Federal Reserve. It's divided. And when you're this divided, it's difficult to provide guidance about what you're going to do next. Because if you're trying to lead this committee, trying to reflect the consensus that doesn't exist is basically impossible.
December 1st. I can't wait to hear that Q&A. This is going to be huge.
I got to go back and study when the last time this really happened, where you had one up, one down, one hawkish, one dovish as well, pushing against the chairman. And it speaks to the two parts of the country that are out there. My idea that there's two R-stars. You see it with the shutdown again, and part of America flat on their back. You've got, it's amazing to me to see Myron 50 beeps in, John, and let's say you want to go the other way, it's a 75 beep gap. I don't believe I've ever observed that. I'm sure I'll stand corrected, but there it is.
The last time we had a dot plot, there was massive dispersion. I think you know whose dot's at the top now, and we knew whose dot is at the bottom. Mike McKee, I believe, is still with us. Mike, the credible argument here, are there credible arguments to do nothing and credible arguments to go even harder?
Well, the credible arguments to go even harder are a little bit harder to make because financial conditions are pretty easy right now, and the markets have been soaring in recent weeks. No change there. We did see interest rates rise a little bit this week as perhaps the markets got a little concerned about inflation going forward. Jeff Schmidt's case is probably easier to make in the sense that inflation is still rising, even if we are seeing the Fed cut rates. That could only be a problem going forward, is his view. And there are people on Wall Street who certainly share that.
Michael McKee, thank you, sir. You get into the news conference. Mike McKee there breaking down this decision. The Federal.
Yeah, that's huge. So basically, let me go ahead and share the press release they just came out with. Let me see if you guys can see this. Okay, 1 sec here. That's not the correct screen. Okay, and you can go to the Federal Reserve website, and then you can read this yourself if you want to. But right now, it does say that all available indicators suggest that economic activity has been expanding at a moderate pace. That's what I talked about with the GDP. Job gains have slowed this year. That's an understatement. And the unemployment rate has edged up but remained low through August. And again, the data that we're missing is September, right? And more recent indicators are consistent with these developments. So that's the questions that if I were a reporter, I want to ask and say, what most recent indicators are you seeing as the Federal Reserve chairman or as the committee, right? What they're seeing. Inflation has moved up since earlier in the year and remains somewhat elevated. Yeah, no kidding, right? It's at 3% now. And it's, yeah, I know they say 3%, but if you look at like beef prices are up like 16% or something like that. Can't even buy steak right now. It's like almost $10 a pound if you go to Costco. But anyway, the committee seeks to achieve maximum employment and inflation at the rate. Yep, blah, blah, blah. We know that. In support of its goals and in light of the shift at the balance of risks, the committee decided to lower the target range for the target funds rate by 0.25 percentage point. So that's 0.25 or 25 basis points if you're not good with math. And so the Fed funds rate is going to be lowered to 3.75 to 4%. So right now it's going to be down to 3.75 to 4%. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data if the government reopens and the evolving outlook and the balance of risks. And the committee, this is a huge one right here. The committee decided to conclude the reduction of its aggregate securities holdings on December 1st. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. Okay. I would be, man, the stock market is historically, it does go up. Right now, it's on the trend of going up, right? If you pay attention to whether you have a TSP, 401k, Roth IRA, taxable brokerage account, if you have individual stocks, generally speaking, most stocks are up, right? Microsoft might have a hard time after the earnings today because their entire server is down because some of my apps are not working. But this is big news, really big news. And I'm going to type it on my Instagram here. And if you have seen my price tracker. Let me see if I can share this here. TSP. If you guys go to firesidechat.com/resources, and you can sign up to become a free resources member, and it's you don't even have to be a member, but it's going to show you like the TSP price tracker, and it tells you all the indices, or I should say indexes, because I'm an American, indexes for each international or index fund. All right, so let me share this real quick. So right now, if you take a look at this is crazy. The C fund is up 18.35%. So this is the S&P 500 index fund is up by 18% since January 1st, 2025. This is the year-to-date performance. And take a look at this. S fund 13%. And I talked about this in my private group because back in April, May, this was down by -6%. And I talked about that. And people were like, S fund is a dump, right? But I said, as soon as the Federal Reserve starts signaling rate cuts, S fund is going to start taking off. And I'm not giving you any personalized financial advice, but when it comes to small cap, if you take a look at 2020, small cap stocks did better than the S&P 500 because why? The Fed cut the interest rates all the way down to zero, right? So that was something that I said you need to take a look at the Russell 2000 or other small cap stock index fund, because that is going to rise up since April, and that was on April 1st during the Liberation Day announcement from Trump, right? And now it's up almost 17% since April. And if you look at, actually, no, that's like 19% actually. And then if you look at iFund, it's approaching 30% return. And this is the International Stock Index Fund. And international funds have been kicking butts, to be fair, this year, right? A lot of money has been going overseas because of the tariff situation. And, people were uncertain about, what that's going to do with the U.S. stocks, because a lot of people thought that S&P 500 was overpriced, overvalued. To be fair, they're not wrong. The S&P 500 is pretty overvalued right now, right? And so people are kind of like banking on, it's probably going to crash down and it's not going to do as well. So people are putting money into the international market. And to be fair, this is a really, really good return right now. And even if you have a life cycle fund in your retirement in TSP or any life cycle fund, right, you're barely beating the S&P 500 right now. So if you have 2050 life cycle or target date funds, you're outperforming the S&P 500 because of the International Stock Index Fund in this specific life cycle fund or this target date fund. So it's really interesting. If you go to 2055, 21% return, 21% return, and then you can ignore that 2075 because that came out in July. So they only have the price from July 1st, I believe, but everything else is pretty accurate. So you can go to firesidechat.com/resources and you can get this for free. You can bookmark this page. You can do whatever you want with it. And I have some retirement calculators that you can use, right? So you can take a look. Let me see. Was there anything else to that tab? I don't think so. No. Nope. I don't. Let's take a look at a market here. Let me share this instead. Let's listen in while I'm doing some research.
Yes, but as you said, you need some street cred, and he's got it from being Treasury Secretary. And he does have a view. He does believe fundamentally that a lower interest rate environment frees up businesses and households, and ultimately that's good for the U.S. economy. Bob, I think you can't fault him on that.
Both you and Rich are exactly on the money, and a lot of people following this situation agree with you. TK mentioned Neil Data a little bit earlier on in the program. If you want a Fed chair that's going to lean towards rate cuts and can influence and persuade the rest of the committee, he's already on the FOMC. It's Governor Chris Waller. Yeah. The outstanding question at the moment is whether the president wants to go along with him. Rich, you've sat in the room with the president of the United States and you've had these conversations. What are the interviews like, Rich? What does the president ask?
Yeah, Jerome Powell is going to speak in about 17 minutes. So he is on time. If this is your first time watching this, but he is very on time. And his Q&A session is going to be the keys. And if you look at the stock market chart, you're going to see some charts start moving based on his responses. So it's really interesting to watch.
But Chris checks a lot of those boxes for sure.
Rich, we'll keep you out of trouble. It's good to see you, as always.
Please,
the former Fed Vice
John.
Chair, Richard Clarida. Rich,
He
thank you.
can't get off soon enough.
He wants to sell books in a few years, TK.
Just saw that announcement that the GM is laying off 1,700 workers at plants in Michigan and Ohio. And Amazon is laying off 30,000 corporate employees. So, wow. Okay.
That had on their dots either no cuts or only the one cut that we had, and dissents are rarely done in a vacuum. And I think Schmid's dissent was also in line with another 6 of those 19 participants that did not think we needed any additional cuts right now. And I think that's what was important. I think it was very important with the first meeting with Governor Moran at the table, knowing that he was going to dissent and be an outlier on the dot plot, that you showed solidarity within the Federal Reserve. But we are going to see a lot of tension going forward, because this is a really difficult time. 1, we're flying blind. 2, we've got inflation is up and unemployment is edging up as well, and the labor market is slowing. You add all of that together and you get this sort of stagflation whiff, which is what makes this Fed.
Yeah, you bet the Fed is going to start printing money again. Yeah, they are.
Absolutely nailed it. And Dan, in many ways, not news, because we saw this in the dot plot last time around, just massive dispersion, a huge difference across the board with different Fed officials and what they expect policy to change and how it's going to change in the year to come. Dan, you mentioned inflation, and I think we've got to talk about this. This is an interest rate cut that comes a week after an inflation report that showed inflation at 3, not at 2, but at 3. How credible is that pursuit of 3%, given that we've missed that 2% target, for so long?
Well, that's what the concern is. The argument, I do think that Jeff is sort of on a little bit firmer footing here. We know that this is a risk management cut. It's not clear that rate cuts alone will actually stimulate employment in this economy right now. I think there's some structural issues that are suppressing employment, which makes it much harder for the Fed to actually have an impact on employment. And lower interest rates tend to accrue to higher income households more than they accrue to lower income households. So, that doesn't help the inequality problem that we already have out there. But I think it's really important to understand that we've got this situation where 40% of that CPI was imputed. Many of it is credible imputations where they get an easy substitute. Some of it's based on history. And if prices are changing on a real-time basis more rapidly, we don't know that. The other concern is that we have had more than 4 years where the Fed has not, the proximity to pandemic inflation, had price stability yet. And that gives us a muscle memory that ups the risk that this is not just a look-through moment. That is the Fed's, certainly Powell's base case, is it's a look-through moment with a hedge. We don't want to go too far. And I think that's very important, is that you've got sequencing of tariffs that mimics inflation, and it ups the ante that we get a more persistent bout of inflation. The Boston Fed came out October 9th with a study saying that they thought inflation expectations are becoming unmoored.
Diane, from the NBC affiliate in Chicago, I think this is so important. There's 1.9 million people in Illinois that are in food lines. In November 1, it's over. It's $187 a month benefit for food, the SNAP program in Illinois. I understand that could be fixed in one moment as the president, the Democrats decide to end the shutdown. But given that, the chairman must address that in this press conference. How will he do that?
What Powell has always done is said we're doing this for the American people, and he'll lean into those issues. I think one of the issues, the 750,000 people that are either furloughed or working without pay at the federal government, the collateral damage on contractors as well, and the ecosystems and entire communities in which they live. And now 1 in 4 children, you're talking about losing food stamps or SNAP, the SNAP funding. That is huge. And, children with hungry bellies can't learn. This is very important. In fact, my son's birthday is in a week and a half. half, and the one thing he asked me for his birthday is to donate to the local food bank because he sees the lines already. And I think this is, I talk about breaking bread is better than breaking ties. This is a time to share your bread because it's very hard for too many.
I totally agree with you, and we all do. I think that sentiment is shared by everybody who watches this program. The risk is for a monetary policy official is that they become seduced by that argument and get themselves in a wealth inequality game and fuel exactly what they're trying to prevent. Because, Dan, if you've got assets right now, game on. Keep cutting interest rates.
Yep.
Dan, what difference does it make to the people struggling in this country at the moment? The Chairman Powell and the committee cut rates by 25 basis points. And how does it tackle wealth inequality? That's the risk for the chairman. That's not his job. That's not his mandate.
Right.
The politicians in D.C. need to address that.
Yeah, so the biggest thing that is happening with the government shutdown is that the SNAP benefits will end on November 1st. So 42 million Americans rely on SNAP to help cover the cost of groceries, okay? So when that money runs out, this is going to be a crucial week because you can bet that Congress is going to get some calls, right? And the states, including my state in Nevada, I know they filed a lawsuit against the federal government to continue the SNAP benefits paid out to the recipients after November 1st. I am not as confident that the SNAP benefits will continue if the government shutdown persists, right? I mean, you could blame either party for this, the Republicans or the Democrats on they're feuding over this, the healthcare bill, but then when the benefits start to run out. So during the government shutdown in the first month, the people who are going to be affected are mostly federal employees, military members, right? I'm a veteran myself, and I went through the 2011 shutdown, and I remember I didn't get my 2 paychecks. That affected me because I didn't know any better back then about how to delay my payments, delay my debt that I had back in the days. I think financial education is much better now. There's much more network or better resources for people to find. But the people who were affected back then, that was the federal employees, military members who didn't get paid. Now, November 1st, starting on Saturday, guess 40 million Americans are going to be affected because those guys receive SNAP benefits. So people who are using EBTs to purchase groceries, right? And they get those food benefits because they're low-income Americans. Now, each state has its own system of how and when payments are issued. The benefits are, they're loaded onto the EBT card, right? If you've never had EBT, that's awesome. That's awesome for you. But when I was I remember, I'm not going to bring that up. It works like a debit card, basically. And when you go to, say to the grocery store, you use the EBT and pay for the groceries. Now you got Department of Agriculture that runs SNAP, and they already said that the monthly benefits will not be going out as long as the government stays shut down. And some states are trying to find ways to keep the funding going. And but the vast majority of the families, because some states are just as broke, right? They get so much in tax revenue for funding that they don't really have the money to cover it. So when the government, the federal government, dries up on that the EBTs, there are very low income families who will not be able to afford groceries. Now, when it comes to let's sit in that family dynamic, right? Like my family and I, we were super poor when we were, when I was a kid. And I just always remember that if we have to skip any bills, it will be the rent. If we have to skip any bills, it will be everything else other than groceries, because you got to eat to survive, right? You just got to, be able to negotiate with whoever you're renting from and say, hey, I need to delay the rent because of the government shutdown. Pay for groceries. And then number 2, the most important thing that you got to pay for is utilities. You got to have hot water, right? you get groceries, you don't have hot water, you're not going to be able to cook it. So when I always, talk about finances, these personal finances, about these emergency scenarios where you're not getting paid because of the government shutdown, or because you're not getting the SNAP benefits, your EBT card runs out, you have to do what it takes to maybe hold off on all the other bills that you have going on. I would rather just hold off on your, maybe a credit card bill or something else to make sure that you are able to eat. And there are a lot of resources out there, like the nonprofit organizations that, with the food line. And they just mentioned that in Illinois, they got a whole line going on. I haven't seen in Vegas how the line is, but that's what's going to start happening if the government doesn't reopen, right? A lot of people just have been talking about the federal employees and military members, which I believe they should, they need to get paid, right? But when these SNAP benefits run out, now you're talking about pissing off 40 million Americans, right? So that's going to make a bigger impact on the Senate. Democrats, Republicans, mostly right now it's Democrats kind of like just saying no to restarting the government. And I'm not taking any side at all, but this is gonna be bad for the Senate if they don't figure something out this week. And this is going to be a very, very crucial week. Let me take a look at the Senate and see what they're doing right now, because I am kind of curious.
Yes, how is the guess that you have of this moment of AI, how is it changing your view, your overlay of productivity?
Yeah, I think the productivity story is really the critical question for the Fed at the moment. And we heard this from Governor Waller in his comments before the blackout period. And it's really because we have this huge divergence between real GDP growth that is very strong, almost 4% in Q2. Atlanta Fed is tracking almost 4% in Q3, but a labor market that's weakening kind of meaningfully at the margins. And that is being explained by strong productivity gains. My own view is that, yes, some of this is due to AI, but it's mostly reflecting a very tight labor market that we had in previous years.
Okay, I'm going to come back to that in a second, but looking at the live update, this is from CBS News. So Senate Majority Leader John Thune told reporters at the Capitol, the bipartisan talks aimed at ending the government shutdown have ticked up significantly. So that's good. So the conversations might be a precursor of things to come. So that is good news, because they know that when these SNAP benefits stop, they might get voted out of office, right? But we'll see. The comments came as the shutdown reached day 29, and Thune said there's a higher level of conversation taking place among rank and file senators, and that Democratic leaders are out of the equation with no room to maneuver. Okay. Tom Tillis of North Carolina cautioned against seeing a breakthrough as imminent, saying he has not seen evidence that the talks have progressed to formal negotiations. So they're talking, and that could lead to negotiations. So basically nothing going on. And the Senate is not currently scheduled to vote on the House bill, passed bill to reopen the government on Wednesday, so they're not voting today. They are looking to vote tomorrow for the 14th time. And the apparent move in the Senate comes days before the administration has said it will freeze benefits under the Supplemental Nutrition Assistance Program, which helps 42 million Americans buy food. Okay. And let's see, our colleagues, Schumer said Republican colleagues don't seem to be offering anything different. So yeah, the Republicans are basically saying that you either vote on this or you don't, right? And the Democrats are saying that, well, we're not voting on it. So I think they're putting a lot of, using some benefits. Or first it was the federal employees, and then now some of the benefits are being used as a leverage, which is unfortunate, really. Like there should not, people should not be used as pawns, in my opinion, Okay. Yeah. And that's interesting. So the House staffers set to miss first paychecks on Friday. Our elected officials still get paid. So that's, but their staff members are not getting paid. I think that's something. That's something. Wow. Okay. Yeah, but all right. Let me go back to this real quick.
Centers. What's that going to look like? You tell me.
Governor of Virginia on 14% lift in energy costs.
You're going to want that data center? How many people they're hiring?
Yeah.
I know what it's doing to electricity prices. How many people they're hiring? Not many. It's pretty Labour light. Matt Lazzetti of Deutsche Bank. Matt, thank you, sir. Always good to hear from you. Matt Lazzetti there of Deutsche Bank, breaking things down, called correctly the end of QT. That's exactly what we got about 27 minutes ago. Bob Michael, you're fantastic at this. Going into the news conference, questions for Chairman Powell. What would you like Mark McKee to ask in a moment?
I think he's got to press them on what are they seeing from their own sources of data? What are they seeing from the regional banks and their thousands of economists? They're talking to businesses every day. They didn't make this decision blind, much as it creates a wonderful narrative for the three of us. They reacted to something. What was that?
What do you think the next decision hinges on? What are the metrics? If we don't have the data, let's say the government's still shut down.
All right, Jerome Powell is coming on in about a minute.
I think it's going to be anecdotal evidence from businesses. If they're still in a pause, hire, and fire, doing neither, then this Fed will respond by cutting rates 25 basis points.
What is your shop's 12-month call on 10-year yield? We're now, I'm going to say, a 399, 398. John's in charge of that. I just look at the Dow Jones Industrial Average. John looks at all the rest of the data. But on the 10-year yield at a 399.
Let me know in the comment section down below if you're a veteran
let's start
watching
with
this.
Fed funds. We see
I
that
do
around
have
3
a
and 3/8%.
Veteran Day special
I think you're going to see
discount
the
coming up
10-year
if you do want to
somewhere
join
around
the
3
private
3/4%.
community group.
Okay.
Michael,
To keep
JP
track of
Morgan,
the
this is fun.
TSP and
Good
stuff
to
like
see you.
that.
Thanks for
And
dropping
I'm going to send it
by.
out soon.
We've said
But
a
you
few
can go to
times on this program over the last few
fireside.com/resources
meetings that these
and just
meetings
get
are
free
going to
stuff
get
if you want
harder
to. All
and
right?
harder for this Federal Reserve. At the next meeting, when Chairman Powell convenes things, think about things.
He is
Today, the
on
good news,
time,
no
so he should be
forecasts.
coming out
Imagine how
soon.
difficult it would be to provide forecasts in a moment like this. At the next meeting, can't escape it. This committee will have to put together forecasts for 2026 with the potential of not having any data at all. And even if they have the data, that data could be very, very messy. On top of that, Tom, we might have that shared decision from this administration, which will take away the ability to guide into 2026 anyway.
On this Wednesday, all this talk here as we go to this conversation, the questions and the answers, we have to remember that in, an hour and a half, these mega companies are going to show profit and cash flow that is not in any of our textbooks.
This is why, Tom, so many people right now are so bullish. What matters to the equity market? Not payrolls. I've said a few times, if I told you the payrolls data at the start of this year, at the start of 2025, you would have been hopelessly bearish on this market.
Correct.
What's mattered to equities has been earnings. What's mattered to the man that's about to step into that room is the step down in payrolls. So the market gets the best of both worlds, gets the earnings one and gets the interest rates reduction as well, too. And the man who's about to step into the room is going to deliver potentially another 25 basis point cut at the end of the year. That's the reason why so many people right now have been bullish this equity market. Equities into this news conference at all-time highs on the S&P 500 up by 0.2%. The FOMC divided, voting to cut interest rates by 25 basis points. Here's the chairman of the Federal Reserve.
Here we go.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today, the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Questions?
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't go for it,
Jerome Powell is being hawkish right now.
Exercise. At what point do you
market
conclude
is
that
pumping
you've
some
taken
dollars
out enough
right
insurance?
now?
Are you looking for some kind of improvement in the outlook? Or could this unfold along the lines of last year, where you made a sequence of adjustments and waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation. We saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management.
I told you the chart's going to start moving based on his
sort of the same logic.
His responses.
As I mentioned, going forward is a different thing.
Claire. Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other, and they also have different levels of risk aversion. And some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, And as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Well, the stock market hates its responses so far.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a little bit or a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, again, with the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
People are buying a dip now, too. Now the market's going back up and they're elevated.
Thank you, Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get. Like I mentioned, what we get in the labor area, we get some data in inflation, some data in economic activity, and we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things, but I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's, the meeting's, I guess, 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then,
saying Janet Yellen
could
was
be
way
an
better
argument
as
in
a
favor
reach.
of caution about moving. But we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop at the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be. Right now, it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding Treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation, but we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments, but so directionally,
price index.
It was a little softer than expected, and we always break it down into the 3 components. So basically, you've seen goods prices increasing, and that's really due to tariffs, and that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services, and that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be 5 or 6 tenths, and so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case, and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market, is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think
that's what I was looking for.
Know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the beige book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all. They were starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully. And yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are. If you listen to the earnings calls or the reports of, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then? Well, the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4 where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth. That the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read.
So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, let's pause here kind of thing. And a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
And so on that division, then, you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And, we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Jerome Powell is getting fussy.
Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on. But it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand? And and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools. But others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think, some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI, of the data center story. I think, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring, and that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that and has been growing and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher end consumers, or maybe skewed that way, but the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, maybe growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But, you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed. But you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies. And I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to. I know those discussions are really just getting going. They haven't come to the point where they're where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, there's no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney.
Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two, and so it's a challenging thing. And as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it, and that's what we have. that makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this. And I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. And you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
Well, that wraps up the news conference from Chairman Powell.
The press conference. So just to give you a summary of what was just said, well, the stock market is not reacting well to the news. It actually nosedived. It dove by about 1% for QQQ, and then the S&P 500 was also down, but people start buying the dip, and you can see that Russell 2000 also dipped, because remember what I said at the earlier in the live stream is that small cap will tend to take off when the interest rates start to go down, right? So the one thing that that Jerome Powell said that led to the market sell-off was, he said December rate cut is not a foregone conclusion. So I put it in the comments that triggered the market sell-off was a December interest rate cut is far from certain and is not a foregone conclusion. Remember what I said, every word matters. He looked a little fussy too. He looked very irritated, responding to one of the Fox business reporters. But it sounds like several committee members are not on the same page, which is really interesting. And so the market tanked for a little bit, and then people started buying a dip. But he did mention several times that the government shutdown is a factor because there's no jobs data, right? They're not getting the unemployment data. The last one we got was August, and that was over 2 months ago, right? And the last unemployment rate is at 4.3%. So Jerome Powell is kind of saying that if the government doesn't reopen, we're probably not going to cut rates. The market didn't like it, and I bet you Trump didn't like it either. So if I have to guess, Trump is probably going to put something on Truth Social later on and say, what does he call Powell? I don't know. Well, I can't remember the nickname. It's like Sleepy Powell, or it wasn't Sleepy Powell. Something else. But anyway, that could be a factor in signaling that they need the government to reopen to vote on the December interest rate decision. Now, speaking of the voting portion of it, so the committee members, everybody voted for, not everybody, almost everyone voted for the 25 basis point rate cut today, right? Powell did it. Williams did it. That he's the vice chair. Michael Barr, Michelle Bowman, Susan Collins, Lisa Cook, those people, right? Excuse me. And people who voted against this action was Stephen Moran. I'm not surprised because he wanted the 50 basis point rate cut. He was pushing for that. So he voted for the 50 basis point rate cut. And Jeffrey Schmid was the only one who said no change to the target range and keep the federal funds rates the way it is. So he voted on no rate cut. So almost everyone voted for the 25 basis point rate cut. One person said, I just want we should have cut by 50 points. That was Moran. And then the one committee member said, that was Schmid, said we should not cut rates. Okay. So that's what they were talking about, that not all committee members are on the same page about this, which is really interesting. So the other thing that was talked about a lot, because their primary mandate now is on the labor market. So what's driving the labor market, the weakness to the labor market? And a lot of reporters brought up AI. AI is a concern. It is, because Amazon is cutting 30,000 jobs because of AI, right? Someone else just announced, was it a layoff? It was a GM. GM was laying off like about 10,000 employees, I think. And that's pretty significant, right? So those are all coming, like, that's why AI is going to replace a lot of jobs. For example, if I'm going to create a thumbnail, I want a thumbnail designer for my YouTube channel. But if I have AI that can create thumbnails, I don't need that thumbnail designer anymore. And that designer is out of the job, right? So that's kind of like the trend that's been happening over the past year and a half. And that's why the labor market is showing some weaknesses. And Powell mentioned that job creation is very low. AI is a factor. He didn't say AI is a factor. I'm saying AI is a factor. So there are not as many jobs open right now, but unemployment on the supply side or the demand side is not as bad, but they are seeing a lot of weaknesses. And that's why it's concerning to the Federal Reserve and saying that, well, we're seeing some weaknesses, but if the government doesn't reopen, then we may not cut rates. I'm like, oh man, that sounds like a message to Congress saying that reopen the government or we're probably not going to cut interest rates. That's kind of how I heard it. Let me know in the chat if you heard it otherwise. But that was really interesting. And the other thing he said that was interesting, I took the notes on this. Where is it? He said, let me see. Okay, so Powell said there is a growing sense among policymakers that it may be time to pause and assess the impact of the Fed's 2 cuts this year before moving again. So he said we're at a place now where we have, in fact, cut 2 more times. We're 150 basis points closer to neutral, wherever that may be, than we were a year ago. So there's a growing chorus. I typed it up. Chorus now of feeling like maybe this is where we should at least wait a cycle. Okay, hawkish, right? That's really hawkish. why do you think the stock market reacted to the way it did, right? And now it just sounds like, well, maybe we're just not even going to cut interest rates because we may need to wait a little bit just to see how it goes. Maybe we need to pump the brake and see how our economic data looks going forward. Inflation is flaring up, right? We just hit 3% CPI, and core CPI at 3%. How does that look for PC inflation? And PC inflation is coming out on Friday. Is it? Let me check. Yeah, PC inflation is coming out this Friday. The first estimate of the Q3 GDP is coming out tomorrow. So we're going to find out how our GDP has grown from Q2 to Q3. Now, Q2 was 3.8%. They're projecting that this is going to be 3%, right? And then JOLTS, which is the job opening and labor turnover survey, it is coming out on Tuesday, November 4th. We may not even see that and see how that goes. And then on November 7th is going to be the unemployment data that we may not see if the government shutdown continues, right? You see where this is kind of like the Fed is like, well, there's not much we can do if we can't see the data. And that's really what was concerning to the investors. And the other update was, so central bank, they are watching layoffs very, very carefully. So when there are fewer job creations, when people get laid off, like think of yourself in their shoes, right? So you got laid off from the job because AI took your job. Now you go apply for a similar job that you're trying to do, but you were in that same career field that you've been working on for many years, but AI has taken over. Just use that thumbnail designer as an example that I used earlier. Now you're a thumbnail designer trying to become a thumbnail designer for other YouTube creators, but they're also using AI now, right? You see what I'm saying? Now that person is not going to be able to find a job because every YouTube channel is using AI to create thumbnails. You see what I mean? So that's why they're keeping an eye on the layoffs, because it is very sector specific. It's not saying that all restaurant workers are going to be replaced by AI now. No, right? You go to McDonald's, you're still going to have humans working there in the drive-thru, not taken over by AI yet, and they're going to mess up your order in the drive-thru. It's just a fact. But you see what I'm saying? Not every sector is going to be replaced by AI right away, but the tech sector especially is getting hit hard right now because they realize, well, we have AI that can do the job of 20 people, and why should we hire more people when we can save money on the labor? And that is the largest expense item on any company balance sheet. If my company, this Fireside Chat balance sheet, the highest expense item is labor. The people I pay who work for me, and my 6 employees, right, working on this channel, helping with with my clients and their spreadsheets, upgrading the spreadsheets, making better programs for the budgeting, investing, and all that stuff. I pay those people, and that is the highest expense item. I'm not saying that I'm going to replace those people with AI. If my employees are watching this, don't worry about that. I'm not going to hire a robot or AI to potentially, okay, well, let me back up a little bit. If I were, let's say, another business owner saying that, well, if I want to cut cost on my company income statement, right, with my expenses, the first thing I'm always going to look at is the labor, because labor costs a lot. I got to pay employees benefits. I got to pay the taxes on behalf of the employee, right? The Social Security tax, Medicare tax, a lot of that. I could write those off, but it is still a lot of money to pay someone. You see what I'm saying? And that's why AI was one of the center topic during the Q&A press conference. And it is a concern. It really is a concern. And there are a lot of people saying that AI is going to destroy humanity. I'm not that far saying that the AI is going to destroy us, but it is a legit concern for a lot of tech workers, especially who have been doing their jobs for a while, being replaced by machines. Man, it sounds like I'm in the Terminator movie, but that's the reality, right? And Powell said you see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs. And much of the time they're talking about AI and what it can do. We're watching that very carefully. So Amazon, right, they're slashing a total of 30,000 jobs, and UPS, wow, I just got this news. UPS revealed that it would terminate 48,000 employees this year. That's UPS, okay? And Target is going to eliminate 1,800 corporate jobs, and this is all happening now, right? Okay, so now Paramount is going to lay off 1,000 workers. So, you know, job creation, when that slows, people are going to struggle to find a new job. And I don't go on TikTok, but people send me TikTok videos, and then people are struggling to find a new job. It's a fact. It really is hard to find a job. I tell my private clients, this is the state of the economy right now. Hold on to your job as much as you can, even if you hate it, because it is difficult to find a new job unless you have a sure thing that you're going to start that new job, start it, and then quit your current job, because it is that tough, right? Buckle down. I've been saying that for a while, but people need to buckle down with their jobs, and it's going to get difficult with the labor market. And I have been signaling that since May this year, since April. Yeah, in my private community, I said the labor market is bad. If you watch my video, go to my channel and check out that stagflation video. Just type in fireside chat stagflation. I made that video a while ago, several months ago. There were a lot of signs in that video that people are now seeing. And just, you know, it takes a minute to see it, but when you start seeing all the weaknesses, and when I work with clients on a daily basis with the job market, job losses, you know, you start to see that a lot. Not everyone can see that because you're not in my line of work, right? It's really, really unfortunate to see that. But when you look at the Great Recession in 2008, when the stock market tanked by over 50%, right? And then it came back up real fast, 2009. Right? 2009, it started to recover, and then people who stayed in, they made money. Labor market, on the other hand, it took them all the way to 2016 to get from 10% unemployment rate to about 3%. No, I'm sorry. It was about 3.5% to 4%. Take a look. Take a look at the chart. See how long it took. It took 8 years to get to the 4% unemployment rate. And if this labor market, if the Federal Reserve doesn't take it seriously, and I know they are, but I feel like they need to cut more rates. That's my personal opinion. If they don't cut rates, like enough rates going into 2026, we could see the unemployment rate going up to 5%. That's just what I've been seeing. My opinion, my personal opinion. Let me know if you think I'm wrong. Okay. Let's see. But yeah, that's pretty much the summary that I got from the Fed. Yeah, I already talked about the quotes. I took a bunch of notes on this, but you know, I really encourage you, if you can, take a look at your finances. There are things that you can control, and that is your personal finances. Okay, that's what's coming in, what's going out. That's all you can control. Congress, they're going to do what they're going to do. The government shutdown may continue. The government, you know, the inflation may continue to go up. But what I want you to do is take control of your finances and pay attention to your expenses, right? Can you cut something? Can you put a little more cash into your savings? Are you trying to invest aggressively now? I mean, the market keeps going up, right? Just when unemployment goes up, doesn't mean the stock market is going to tank. You know, stock market doesn't directly correlate. Stock market performances don't always correlate with how our economy is. That's just the fact. Just take a look at all the charts. But take control of your finances, pay attention to what you're spending, save money. You got to, and pay off your debt. Pay off your stupid debt and get rid of it and take control of it. All right. I will be doing some TSP live stream next Tuesday, this coming Tuesday, and I'm gonna have some Veteran Day special for not just for veterans, but people who have TSP. But there's gonna be some discount If you do want to schedule a 60-minute consultation, you can go to firesightchat.com/consultation. And you can always join our private client program at firesightchat.com/private clients. But thanks for tuning in. This is a beast of a 2-hour live stream, and I will see you guys on Tuesday.